For 6 years in a row, Fortune magazine named Enron the most innovative company in America. Its stock price rose 1,000% through the 1990s. Wall Street analysts called it a buy. Employees put their entire retirement savings into it. Pension funds across the country held it. In 2000, Enron reported revenues of $111 billion. It was the seventh largest company in America. In December 2001, it filed for bankruptcy. 20,000 employees lost their jobs. Their retirement accounts, which held Enron stock, were wiped out. Some lost everything they had saved for 30 years. The fraud that destroyed Enron was not hidden in some obscure corner of the company. It was hiding in plain sight, in the financial statements, in the accounting methods, in the footnotes that nobody read. Today we're going to read them, and we're going to understand exactly how $60 billion disappeared, and what it means for how you evaluate any financial situation you ever encounter. Enron started as a simple company, a natural gas pipeline operator in Houston, Texas. In the late 1980s, under CEO Jeff Skilling, the company made a radical transformation. It stopped thinking of itself as a pipeline company. It started thinking of itself as a trading company, a market maker for energy. It would buy and sell natural gas, electricity, and eventually anything that could be packaged as a financial contract. The pitch was brilliant. Enron would bring the sophistication of Wall Street to the energy markets. It would create liquidity, efficiency, and profit where none had existed before. And for a while, it worked. Enron's trading operation was genuinely innovative. It created markets that didn't exist. It hired the smartest people from the best schools. It built a culture that celebrated risk, rewarded boldness, and fired anyone who wasn't performing. But underneath the genuine innovation was a financial structure that was rotting from the inside. The first and most important trick in the Enron playbook was called mark-to-market accounting. Here's how it worked. When Enron signed a long-term energy contract, say a 20-year deal to supply electricity to a utility, it was allowed to immediately book the estimated total profit from that contract on its income statement today, in full, even though the money wouldn't actually arrive for years. If Enron signed a contract worth $500 million over 20 years and estimated its profit at $100 million, it could show $100 million in earnings right now before delivering a single kilowatt of electricity. This method is legal for certain types of financial instruments. Enron convinced its regulator, the SEC, to allow it for energy contracts. It was the first energy company to receive this permission. The problem is what happens next. If the actual profit from that contract turns out to be less than projected, Enron had to book a loss. But by then, the original executives who signed the deal had already collected their bonuses based on the inflated earnings, and Enron had signed hundreds of these contracts. The losses piled up invisibly while the reported earnings looked spectacular. Mark-to-market accounting turned Enron's income statement into a work of fiction. But mark-to-market accounting alone wasn't enough to hide everything. Enron was accumulating massive debt, billions in losses from bad investments and failed ventures. And debt on a company's balance sheet makes investors nervous. It raises questions. It lowers stock prices. So Enron invented a solution: special purpose entities, or SPEs. These were separate legal companies that Enron created specifically to hold its bad assets and debt. The structure worked like this. Enron would transfer a losing investment to an SPE. The SPE would take on the debt, and because the SPE was technically a separate company, the debt didn't appear on Enron's balance sheet. Enron looked clean. The losses were buried in entities that almost no one examined. But here's the criminal part. Many of these SPEs were funded using Enron's own stock as collateral, and they were managed by Enron's own chief financial officer, Andrew Fastow, who was personally paid hundreds of millions of dollars in management fees for running them. The CFO was hiding the company's debt in entities he controlled and charging the company for the privilege. Fastow made approximately $30 million personally from these arrangements, while Enron's employees' retirement accounts were being destroyed. The most audacious scheme inside Enron was called the Raptors. Yes, named after the dinosaurs in Jurassic Park. Enron's culture was exactly that confident. The Raptors were 4 SPEs created specifically to hedge Enron's investment portfolio. When Enron's investments in other companies lost value, the Raptors were supposed to absorb those losses so they didn't hit Enron's earnings. But here's the circular madness of how they actually worked. The Raptors were funded with Enron stock, so when the investments they were hedging lost value, Enron's stock price also fell, which meant the Raptors had less money to cover the losses they were supposed to hedge. Enron was using its own declining stock to insure itself against its own declining investments. It was a house of cards inside a house of cards. records. By 2001, the Raptors had a $700 million hole in them that Enron would need to fill, and Enron didn't have $700 million to spare. The entire structure was beginning to collapse. While Enron's internal finances were deteriorating, its traders were making things dramatically worse. For the state of California, in 2000 and 2001, California experienced a severe energy crisis, rolling blackouts, prices spiking 800%, businesses shutting down, people dying in the heat. Internal Enron recordings, later released, revealed that traders were deliberately manipulating the California energy market. They had names for their strategies: Fat Boy, Death Star, Ricochet, Get Shorty. These were schemes to create artificial shortages, overload transmission lines, and exploit regulatory loopholes to drive prices as high as possible. California paid an estimated $40 billion more than it should have for electricity during this period. The traders laughed on the recordings. They joked about stealing from Grandma Millie. Enron was not just committing accounting fraud, it was actively harming millions of people and recording itself doing it. The collapse began in August 2001 when Jeff Skilling, who had become CEO, suddenly resigned. He cited personal reasons. In companies with financial problems, a surprise CEO resignation is almost always a signal. Wall Street noticed. Then in October 2001, Enron announced a $1.2 billion charge to earnings related to the Raptor SPEs. For the first time, the losses buried in the special purpose entities were becoming visible. The SEC began an investigation. In November, Enron was forced to restate its financial statements going back to 1997. It admitted that it had overstated its earnings by approximately $600 million over 5 years. The stock, which had been $90 just 12 months earlier, was now trading at less than $1. Enron tried to arrange a merger with its competitor Dynegy. Dynegy walked away. On December 2nd, 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. 20,000 jobs gone. Employee retirement accounts that held Enron stock wiped out. Some employees had been locked out of selling their shares during the final months while executives sold theirs. The executives knew, the employees didn't. The three men at the center of the fraud faced very different fates. Andrew Fastow, the CFO who designed the SPE schemes, pleaded guilty to fraud and conspiracy. He served 6 years in federal prison. He cooperated with prosecutors and testified against his colleagues. Jeff Skilling, the CEO who built the culture, was convicted of fraud, conspiracy, and insider trading. He was sentenced to 24 years in prison, later reduced to 14. He served 12 years before being released in 2019. Ken Lay, the chairman and CEO who presided over everything, was convicted on 6 counts of fraud and conspiracy. He died of a heart attack in July 2006 before sentencing. Because he died before his appeal was heard, his conviction was legally vacated. In the eyes of the law, he died unconvicted. Arthur Andersen, the accounting firm that audited Enron and failed to catch or report the fraud, and was convicted of obstruction of justice for shredding documents. The firm, which had 85,000 employees worldwide, ceased to exist. The collapse of Arthur Andersen is one of the most significant consequences of the Enron scandal, because it demonstrated that the gatekeepers of financial honesty can fail just as catastrophically as the companies they're supposed to watch. So what does Enron teach us beyond the obvious lesson that fraud is bad? Lesson 1. If you can't understand how a company makes money, that's a warning sign, not a reason to trust the experts. Enron's business model was deliberately opaque. Analysts who admitted they didn't understand it were called unsophisticated. Complexity is sometimes a feature, but it's often a mask. Lesson 2. Accounting methods matter as much as the numbers themselves. Enron's revenue was real. Its profits were manufactured. Always ask, how are these numbers being calculated? Under what assumptions? Mark-to-market accounting isn't inherently fraudulent, but in Enron's hands, it was a tool for fiction. Lesson 3. Watch who profits when you can't. Fastow made $30 million managing entities that were destroying the company. When insiders are extracting money through complexity that outsiders can't follow, something is wrong. Lesson 4. Culture can override controls. Enron's culture celebrated risk and punished doubt. Anyone who raised concerns was sidelined or fired. A culture that cannot tolerate honest questions is a culture that is hiding something. Lesson 5. 5. The gatekeepers can fail. Arthur Andersen was one of the most respected accounting firms in the world. It failed. Auditors, analysts, rating agencies, these are not guarantees. They are imperfect humans with their own conflicts of interest. Final responsibility for understanding where your money is always rests with you. Here's what Enron ultimately was. It was a company that confused the appearance of success with success itself. It reported earnings that didn't exist. It hid losses that were real. It rewarded the people who maintained the illusion and punished the people who questioned it. And it worked until it didn't. The lesson is not that markets are corrupt or that all companies are fraudulent. Most aren't. The lesson is that financial statements are written by human beings with incentives. And sometimes those incentives point in the wrong direction. Your job is to ask the questions that no one else is asking. Read the footnotes. Question the assumptions. Understand how the money actually moves. Because the truth is always in the numbers. You just have to be willing to look. So here's the question. Have you ever trusted a financial situation without fully understanding it and later wished you'd looked closer? Write it in the comments. I read every single one. And if this changed how you read financial news, share it with someone who needs to think more critically about money. I'm Finn, and this is what money is really about. Next week, she's 41, a hairstylist, self-employed, no pension, no 401k, $0 saved for retirement. Where does she even start? Subscribe so you don't miss it.